There may be those among you who, in the recent past, due to the geopolitical situations that linger, face quandaries regarding where Dubai currently stands in the grand scheme of global real estate markets. The usual players in such a context primarily consist of Dubai, London, Singapore, and New York, whereby Dubai has always been compared to the others. Such is no longer the case though. Hi, my name is Madhuri Podeti, and I'm a senior property consultant with Experience Realty. Given all that has transpired over the last 6 weeks, the data has already moved and created a more compelling rhetoric, despite the fact that the allocators of such a paradigm shift have not kept pace. Over the course of this comparative analysis feature, we will be going over 8 major global residential real estate markets and show what it means for the way investors should be thinking in 2026. Let us begin. Given this shift in the way markets are functioning during a period of uncertainty, here is a misconception most investors are working with. They take it for granted that Dubai remains one of the several global luxury real estate markets, a market that is broadly comparable whilst also being broadly substitutable. That if Dubai gets too expensive and uncertain, investors can proliferate their capital to Singapore. If Singapore in tandem starts getting too restrictive, investors will start looking into London, and with more interest and nuance. If London eventually becomes too regulated and thus taxed, investors will eventually settle on New York or Bali as their chosen investment vehicle. Whilst this may have been the accepted modus operandi prevalent over the last 2 decades, that mental model is no longer accurate. Having studied 8 specific markets, namely Dubai, Indian suburbs, London, New York, Singapore, Hong Kong and Bali, the most pertinent observation I came to was that each one has diverged structurally over the past 15 years. Each commands a slightly different spot in the layer cake of global luxury real estate and are thus no longer in the same category. Each one carries a major structural offset that the consensus has not yet fully priced in. And that is where real opportunity for the right kind of investor truly sits. Let us dive deeper and explore the actual nuance of these changes. The crisis comparison. Over the course of my examination, one specific uniting factor emerged as a commonality. Every market has endured at least one major correction since 2008. What's really interesting, however, is the recovery trajectory they each created over the course of said correction. In 2008, during the global real estate crash, Dubai's market fell by roughly 50%. In comparison to this, the United States of America, on average, saw a decline of 30%. Miami and San Francisco each fell around 50% and 40% respectively. Prime real estate in London dropped 15 to 20%. Singapore seemed to have found a competitive median and averaged a dip around 25%. Hong Kong and India faced similar scenarios. Each market faced its own trajectory and all corrected in their own way. However, here is what consensus misses, as that deduction doesn't tell the full story. Dubai, Singapore, and the United States of America all made new heights in the years that followed. Hong Kong and prime central London did not. India recovered at an uneven pace, whilst Bali served a tourism wave but remained ownership constrained for foreign investment. Hong Kong is currently in a 28% drawdown from its September 2021 peak. Prices fell 15% in 2022, 7% in 2023, and yet another 7.1% in 2024. The government scrapped every cooling measure in February 2024. Volumes have slowly started to recover. Prices, unfortunately, have not. Prime central London declined 14% between 2016 and 2019 after Brexit was implemented. In comparison to this, the United Kingdom, sans London, rose 32%. In 2024, the budget abolished the non-domicile tax regime, a foundational feature of the British system since 1799. Non-doms, as they are colloquially known, were the principal buyers of London property above £5 million. Prime luxury transactions saw their biggest decline in a decade in 2025. Now, whilst this may appear as normal market noise on the surface, it is actually a methodical, structural redistribution on where global capital can productively sit. The structural offsets. Bearing this in mind, here is the underlying pattern we can extrapolate. Singapore has the most predictable legal architecture of any Asian market. It also has a 60% additional buyer stamp duty on foreign residential purchases. Simply put, on purchasing a $2 million Singaporean property, a foreign or non-national buyer additionally pays 1.2 million Singaporean dollars in stamp duty alone in cash. Foreign buyers used to make up 3 to 6% of resale transactions. Currently, they now comprise 1.4% of the market. As such, it is safe to say that Singapore is no longer a foreign capital investment destination. Hong Kong, on the other hand, offers freehold and recently introduced zero cooling measures. Whilst this bodes well for the serious investor, it also carries the risk of political integration with mainland China, which is structural and ongoing. When one juxtaposes all we've discussed thus far, we can clearly start to see why these markets have fallen out of contention where investors are concerned. London offers freehold and deep legal infrastructure. It also imposes stamp duty land tax of up to 17% for foreign buyers on properties over £1.5 million. In lieu of the remaining considerations, capital gains tax has been increased to 24%, including a mandatory annual council tax. The integration of the non-dom abolition has drastically mitigated the principal ultra-high net worth buyer cohort almost single-handedly. The United States of America offers the deepest market in the world in transparent legal infrastructure. It also, however, imposes federal and state capital gain tax up to 37% on non-residents. Foreign Investment in Real Property Tax Act, FRIPTA, withholds 15% of gross sale proceeds at closing. Annual property taxes run 1 to 2.5% of assessed value in much of the New York metropolitan areas, thus rendering it a high-friction, high-holding cost market. India, founded on the principles of reformation based on transformation, is an adaptive and engaging market, but is restricted to NRIs and OCIs. Bali, by comparison, is the only market in this examination where foreigners are not eligible for a freehold title at all. The legal access runs through leasehold or through a PTPMA company structure that requires roughly $700,000 in capital commitment. A beautiful market, no doubt, but heavily constrained on all fronts. Each of these markets carries one more structural offset that materially changes the after-tax, after-friction, after-restriction return profile. Having gone over the other markets, let us now contrast them against Dubai. Dubai permits unrestricted foreign freehold ownership in designated zones. No personal income tax, no capital gain tax on personal property, no annual property tax, no inheritance tax. The 9% corporate tax introduced in 2023 explicitly excludes personal real estate investments as one of its governing caveats. Any purchase made via cash typically has a procedural turnaround of 7 to 14 days. Round-trip closing costs are roughly 6 to 7%. The Golden Visa was originally set at 10 million dirhams, then later revised to 2 million dirhams. The down payment requirement was abolished in 2025. There is no equivalent program at this accessibility level in any other market we've examined. When I scored these 8 markets across 8 investment-centric criteria, ease of buying, transparency, capital appreciation, stability, foreign investor friendliness, transaction cost efficiency, legal clarity, liquidity speed, Dubai scored 9.0 composite. No other market scored above 8. The simple underlying point is not that Dubai is the best on every metric. Singapore is more transparent in terms of its regimental legal structures. The United States has deeper liquidity across the board. London has older legal infrastructure and thus more market data than one can draw from. The point is that Dubai is the least compromised market in the dataset, thus rendering it the only one without a major structural offset. Singapore has the ABSD. Hong Kong has mainland integration. London has non-dom abolition. New York has FRIPTA and capital gain tax. Bali has the freehold restriction. India has the NRI gate. Dubai, however, has none of the above as a discernible setback. Dubai is the most open market of them all. The 2008 comparison, why it is wrong. Now, typically when property consultants put out information like this, the reflexive knee-jerk rejoinders that ensue are, what about 2008? What about the current regional geopolitical noise? Isn't this just the late stage of another speculative cycle? Your quandaries, though plausible, are in fact not that pertinent crux. Allow me to elucidate why. In 2008, the Dubai market was over 60% leveraged speculation. Off-plan flippers exited the market in days. There was no escrow law in force to counteract any of this. RERA was newly implemented and still ironing out the creases of its overlap. Project registration was inconsistent at best. The credit zone alone collapsed the market in months. Dubai World, one of the major state-owned investment holding company in the UAE, required $26 billion in restructuring. As such, property prices fell 40% in a single quarter. That market, I'm glad to say, is not this market. In April 2026, the Dubai market comprised over 70% end-user demand. 87% of those transactions are cash. The population now stands at over 4.2 million against roughly 3 million in 2008. There is no Dubai World equivalent in stress. There is no developer insolvency cascade in the pipeline. The regulatory architecture is ironclad. RERA, escrow laws, the 2013 LTV caps, and mandatory project registration are all fully embedded and stress-tested. Comparing 2006 to 2008 is not a contrarian read. It is a categorical error born of inaccurate comparison. A closer parallel of note lies in the Russia-Ukraine war of 2022. That event did not trigger a correction in Dubai at all. On the contrary, it escalated inflows of investment. Sophisticated capital does not flee uncertainty. It seeks the jurisdictions where the certainty premium is highest. In every comparable market transition, the pattern is the same. The investors who anticipate the structural shift get compensated. The investors who wait for confirmation pay for it. The migration data. According to Henley and Partners, the UAE received 9,800 millionaires in 2025, ranked 1 globally, bringing roughly $63 billion in associated wealth. The UK lost 16,500 millionaires in the same year. India lost 3,500. This is not a marketing statistic. It is an incredibly relevant structural data point for our examination. Capital does not migrate by accident. It moves towards jurisdictions where the structure permits it to compound. The directional vector is convergent on the UAE and divergent from 3 of the major markets I examined. When wealth migration data, regulatory architecture data, taxation data, and crisis recovery data all point in the same direction across multiple cycles, that is no longer a hypothesis. That is the manifestation of structural reality in motion. The question for capital allocators in April 2026 is no longer whether Dubai deserves a place in your portfolio. The data alone answered that. The question is the size of the allocation and the entry point that precedes it. For those evaluating exposure right now, the conversation moves from speculative hypothesis to execution. Which segment, which community, which entry vehicle, which holding horizon, which residency layer, where the supply pipeline matters and where it does not. Identifying that opportunity is one aspect of the challenge. Capturing it correctly is where outcomes diverge. This is where the conversation becomes precise and highly nuanced. If you're actively allocating capital, this is typically the stage where it stops being conjecture and starts being strategic. The market is not waiting for confirmation. It is repricing in real time, and the decision is no longer whether Dubai fits into a portfolio. It is how much exposure are you prepared to inculcate before the next leg up. If you're interested in discussing the finer points of this examination in more detail or need clarification on jumpstarting your portfolio journey, please feel free to reach out to me. This is Madhuri Podeti here, Senior Property Consultant with Experience Realty. Take care.